Hey guys, it's May from Markets with May. And in this episode, we're doing part 3 of understanding bank earnings season. In part 1, we talked about how the banks worked in general. And in part 2, we talked about what I specifically tend to look for as relates to macroeconomic information that I pull out of financials earnings season. And now what we're going to do is I'm going to react to this piece from Yahoo Finance that I thought was a reasonably good one, and yet kind of demonstrates how it would be really easy to miss, not understand, or otherwise not catch the kind of oddities of what's said in this video. Now, I do think they did a reasonably good job with it. So I want to go easy on the reporters here. Now, let's give the disclosures and then get into it. Past performance is not indicative of future returns. This is not investment advice. This is for education purposes only. I will disclose that I am both long and short a variety of names within financial services. I do want to give a shout out to Gurula.app. Money goes where it's treated best. If you're interested in what they do, definitely have a look at the show notes, check out their website and see if that's something interesting to you. Now, let me share my screen so we can get into this video. So the name of this video is Earnings, What to Expect from Big Banks This Week. And let me play it.
JP Morgan, Citigroup, Bank of America, and Wells Fargo are among the names that will be reporting their fourth quarter earnings this Friday. Investors will be keeping an eye on how their mortgage businesses are holding up and listening for signs of optimism on the broader economy. Lots to unpack.
Okay, so I wanted to stop there because why is there always a focus on the mortgage market? Well, you kind of actually divide that into two pieces, but you do have commercial mortgages and then you have residential mortgages. And most likely they're really talking about residential mortgages. On the commercial side, I actually pay a lot of attention to that because I can get a good sense for who's actually taking out mortgages. In other words, they need more space. And then who might be having some difficulty where they're actually renegotiating that a bit with the bank. That also is very telling of which industries are experiencing what. On residential mortgage, we care on residential mortgage because residential mortgage is a huge component of consumer debt. So we will be looking for what is it that they're experiencing as relates to that consumer debt. And also to the extent the banks themselves tell you how much or how they're thinking about mortgage issuance in general. Do they want more of it? Do they not want more of it? Are they closing it down? What's going on? And the reason that that's really, really important is because it's one thing to not be able to pay a loan or what have you, and that might not change very much. But if the capital markets, the mortgage markets start to just show some weakness in the sense that they're not going to originate as many loans, then what will happen is that the price of homes will drop to a point that it becomes a more interesting loan to write for the bank. And that has a huge impact on consumer wealth. For example, if you're going to then do something like a home equity line of credit to pay for your college education, your kids' college education, or for some other thing that you need medically, et cetera, you will get less equity on your home if the mortgage market starts to close. Let's continue.
Here with these bank earnings, guys, is this the quarter where JP Morgan CEO Jamie Dimon again brings out the warning on the state of the economy? He certainly could. He's been, I think, very out in front warning about where this economy might go in 2023. Is it also the quarter where JP Morgan starts to pull back on some of its tech investments, given the slowing economy? So those are a couple of things I'm watching as pertains to JPM. And then, of course, on news today of Goldman cutting 3,200 jobs. We knew it was coming, but still to see it is I would say, concerning. And how does that CEO, David Solomon, get on that earnings call and project his business looking forward?
As we mentioned in earlier videos, you do absolutely want to listen for the tone the CEO gives. I would mention with Mr. Dimon, he's been bearish for a really long time. And right, wrong, it's a little bit hard to say, but I would say that I always caution people from taking his tone and carrying it all the way into what JP Morgan ends up doing in earnings. For whatever reason, they don't always match. Sometimes he's more cautious, but because he's more cautious, the bank has fantastic performance, that sort of thing. So let's keep going.
Job cuts coming after we had already seen from JP Morgan and some of the other banks as well, even prior to or during the holiday season, saying that, hey, we're going to need to roll back on some of the bonuses. And that really kind of brings into question what the total compensation package for the existing and the retained base of employees would look like going forward, as the banks are really waiting for deal making to come back in full force, waiting to see where investment banking really kind of regains some type of strength, given some of the equity market declines that we had seen in last year. And so with all of that in mind, this earnings period and what they forecast perhaps is going to be the biggest kind of takeaway item in what they're seeing in terms of deal making and where they're going to be able to drum up some type of demand for their investment banking products as well.
It's a good comment. It's a valid comment. Might have gone on a little longer than I would have liked. Here's the deal. Goldman Sachs and Morgan Stanley are very dependent on that investment banking business. And since they did the job cuts, So they're telling you already that this coming year, at least the first part of it, is not going to be as good as last year, which wasn't stellar, to be fair. So there really shouldn't be a lot of confusion. I do like what he had to say about the idea that we're looking for forecasts, but really what we're looking for is what precisely they would have to see. With Goldman Sachs, they've actually been ever so slightly more constructive in their macroeconomic outlook than other banks have been. So it is a bit of a curiosity. So I agree with him that absolutely, it really is Goldman Sachs that we want to hear from.
Bit of what we've seen from technology, because part of it is sort of a pandemic payback, if you will. That is, Goldman Sachs usually does an annual culling of its underperformers. It cuts them. Didn't really do that during the pandemic. So part of this is sort of now a delayed reaction, a delayed cutting of some of those folks. That's at least some of what is going on there. But we are perhaps going to hear more about cutting from these companies, especially given that maybe they're not totally prepared for what may be coming at this point. For example, Deutsche Bank last week downgrading Bank of America, JP Morgan, and Truist, saying that bank stocks have yet to fully price in a US recession. So are investors fully accounting for the effect this could have on the banks? Are the banks themselves fully accounting for the effect? I think we're going to get lots of discussion around those issues.
Okay, so I'm really glad that she hedged her comment because it was about an 8% headcount reduction. I've definitely seen worse, by the way. It is true, largely speaking, but they wouldn't reduce headcount in this kind of environment unless there really was an issue as relates to what they were seeing on the next 3 months outlook. That's point one. Point two about the Deutsche Bank downgrade and what that might imply to the recession and what's going on. It's actually interesting that he put Truist in there. Truist has been deciding to take this strategy that's very different from everyone else. They have a very particular strategy that they were crystal clear on last quarter, which was that they were going to take the opportunity of other banks being more conservative to go ahead and continue to expand. Truist is in those southern states that have been experiencing population growth, and they have been buying up all different types of banks in the South that are very good and performing because the population growth in the United States in that area has been increasing dramatically. Additionally, the demographic of those states tends to be older, which means that it's beneficial for other areas of the bank. Because once you have the deposits, you can kind of see a little bit about the clients and then try to cross-sell them into asset management.
Seems like there's a disconnect, Julie, because I'm looking at some Morgan Stanley price target changes ahead of earnings. They are cutting estimates on Citigroup and Goldman Sachs pretty significantly. But if you go pull up the KBW bank index, as we're showing here, and these stocks have gone nowhere, really nowhere over the past year, despite rising yields. And theoretically, that should be good for profit margins. I would argue that chart is suggesting we're in a recession at some point this year, and that impacts a lot of the businesses beyond deal making for the banks.
This runs a
Okay, if you thought that was a little bit gobbledygook, that's very fair because that was a little bit gobbledygook. So he first names that there's a downgrade or a reduction in estimates on Goldman Sachs and Citi. And then he talks about net interest income. And it's unfortunate because Goldman Sachs and Citi are a little bit of a special animal. Goldman Sachs does absolutely make most of its revenue through investment banking, and fixed income is not its primary business. Investment banking is just way too large. And then their second biggest business is going to be asset management, but it's not classic asset management in a lot of ways. So net interest margins would rarely be the primary thing that would help Goldman Sachs out. Citi has been selling off assets across the entire globe to try to downsize its business and get out of certain markets that have just been really rough. So, decreasing the numbers on Citi is a little bit of a different animal. And again, even though Citi has a huge commercial bank, I think it's really about those other things. So unfortunately, he picked the two banks that net interest margins probably was not going to be the main thing that people were watching for. Finally, he talks about the KBW index, and Goldman's not in the KBW index because it's primarily banks. But I do want to show you what is in it so that you can see why that's a little bit also gobbledygook a little bit. But like I said, it's very hard to talk on the fly and have things thrown up in front of you, as I can imagine is happening working at Yahoo Finance and having to make stories all day long. He got a little bit mixed up is because they use this KBW index. The KBW index doesn't have investment banks in it. I want to show you what it does have in it. And you can always do this for any ETF. You can always go to Yahoo Finance, or even better, you can go to Invesco's website and find the actual holdings. These are always disclosed for exchange traded funds. But on Yahoo Finance, it's usually approximately correct. And you can just scroll on down and you'll see the top 10 holdings of the index, about 61%. And you can see what is the composite of that. And you'll see Goldman Sachs isn't on this list because it's an investment bank and not a regular bank. Now, one of the other things that he just didn't know, or maybe he did know, but this isn't the appropriate setting to discuss it, is that 5 of these top 10 banks have what I'm going to call issues. They cannot be resolved by net interest margins helping them out in any kind of meaningful way. Okay. And that would be Wells Fargo, JP Morgan, Citigroup, State Street, and Capital One Financial. Wells Fargo just had to pay a huge fee for an ongoing situation, let's call it, that dates all the way back to 2008. They paid about $3.7 billion for failures related to that. Finally, they are probably the tightest as relates to CET capital ratio reserves. And so I'm sure that more than one person, not just myself, is a little bit nervous, even though I would say that Wells Fargo's trade a lot better than I would have anticipated. Okay, they do have less mortgage exposure because of what happened to them. So that might actually just have helped them on accident, to be fair. JP Morgan is JP Morgan. They're such a mix of a bank. Things are probably just fine there. But, the generalized net interest margin piece isn't going to be the only thing that drives those earnings. Citigroup, like I said, is navigating the turnaround and the fact it's still shedding assets to do so. State Street is very leveraged to equities because a huge component of their fee revenue comes from the index business. Decline in the equity markets is going to have as much an equal impact to net interest income, if not, depending on how you think about it, potentially slightly more. And also the data business is a big thing for them, which also tends to ebb and flow along with equity markets doing well or poorly. And then finally, Capital One, net interest income, kind of yes, but the bigger questions that surround consumer lending, which all of the banks technically have exposure to. But with Capital One, it's going to be a little bit more of the deal, for lack of a better way to say it. So those 5 parts of this index would make this index really hard to rally in front of a very controversial earnings report.
A little bit counter to what we typically see from some bank activity, at least during a rising interest rate environment, that typically would be more beneficiary, where they can get more money or earn more from the difference between some of the spreads in their loans. And I think for right now, they're still trying to manage what many other businesses are and trying to understand exactly what their cost structures look like. The cut that we're seeing at Goldman is roughly double what we had seen at Morgan Stanley. That was about 1,600 employees there. And so exactly the number of people that they need in order to continue the operations or the business as usual, when business right now isn't kind of that usual operating procedure, if you will, too.
I feel kind of bad because I do think that this job is really hard sometimes, but net interest margins and the investment banks, it's not going to match. Okay. If you want to talk about net interest margins and suggest that it might help like JP Morgan, which is the largest fixed income house around, maybe, but then you're still going to have to talk about the economy in general and the need for refinancing. Banks that are highly leveraged to investment banking, asset management, or are more equities-based businesses, net interest income just isn't enough to get them over the hurdle, so to speak. That's the first thing. The other thing he could have said that would have kept him in a safer spot is that there are actually a lot of banks that do extremely well, given what's happened with the rising interest rate environment. They tend to be slightly smaller, so regional banks, Truist, et cetera. In that regard, this quarter, it might be more interesting to think about the smaller regional banks and how they do. Now, when I say standalone sort of smaller banks, that still does include something like a PNC, which is fairly large, but it doesn't have as much going on with those other divisions.
If you look at the big businesses of the banks, right? Net interest margin, the difference between what they put out and what they take in, basically, and what they lend, that's going to obviously be a big focus this year. Fee income related to everything from mortgage servicing to the deal making that we were talking about. All of these things are going to be in flux this year and are difficult to predict, I think.
So the way she divided at the end to describe her framework was fee income and net interest income. But as you can tell from my earlier videos, I wouldn't divide it that way. I wouldn't divide it that way because it's very reductionist if you do it that way, because then net interest margins is just a function of what interest rates are doing. And fee income is just whether or not what, I don't know, right? It's just a big question mark of nothing that you can latch onto if you wanted to truly use macroeconomic data to help you understand the banks, or really anything that you're seeing in the economy or in other companies. Additionally, doesn't allow you to take what you get from the banks and apply it to the rest of the economy. So that's another way that I heard the video, which is what inspired me to do this vlog. Now, what I did see that was really missing, there were 4 items. The first is that obviously these banks are going to give us a ton of information on the mix of debt, the geography in the United States, and then in the case of Citi and some of the investment banks, what they're seeing abroad. And that's going to tell us a lot about where the weird spots are, where the health is. Imagine if we start to hear from certain banks that are surrounding the Michigan area that there's issues as relates to, real estate loans there. Well, there's only certain things that exist in the state of Michigan. So there you go. You'll know exactly what that is. Bank of America, if they start talking about auto loans, they're the largest lender to Tesla. So there's things like that that you're going to get inside the earning. Unfortunately, didn't get touched. The second thing that I think totally didn't get talked about is the difference between savings and debt. Banks will absolutely tell you whether the amount that people are saving has increased or decreased relative to debt. So what are people doing? Are they basically not spending and just saving for a rainy day, or are they just not having money because the money is going straight to rent expense and other things? The third thing is the types of weakness in general that they're seeing. These banks absolutely have granularity and who's loaning what to whom and where and why. We've talked about that further in part 2 of this video series. Take a look. And then the final thing that is probably to me the most important thing is what is the strategy each one of these guys is taking, independent of what they're seeing in the economic data. Are they going to contract their book of business and do less loans until they see more clarity? We already know from last quarter, a company like Truist is going to be very aggressive because they believe that their competitors are going to be overly defensive. So they want to take advantage of that. Who else feels that way and who else feels that's absolute folly? I want to know so that I can then use that as an assessment for the rest of what I hear during earnings season. So that's all I have prepared for today. If you needed to see part 1, it is located here. If you needed to see part 2, it's located here. I have a full playlist of different financials, earnings reports, if you want to kind of see what I've thought about the financials in the past. And finally, it would be amazing if you'd like, share, comment, or if you'd like, you could subscribe here. That would be amazing. Until next time, good luck this earnings season. Bye.